Ladies and gentlemen, good day and welcome to the Carborundum Universal Q1 FY22 earnings call hosted by DAM Capital Advisors Limited. As a reminder, all participant lines will be in the listen-only mode and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star then 0 on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Ms. Bhumika Nair from DAM Capital Advisors Limited. Thank you and over to you, ma'am.
Thanks. Very warm good morning to everyone. On behalf of DAM Capital, I would like to welcome you to the Q1 FY22 earnings call of Carborundum Universal Limited. We have the management today being represented by Mr. N. Ananthaseshan, Managing Director, Mr. P. Padmanabhan, Chief Financial Officer, and Mr. G. Chandramouli, Senior GM, Investor Relations. I would now like to hand over to Mr. Ananthaseshan for his initial remarks, post which we'll open up the floor for Q&A. Over to you, sir.
Good. Thank you, Bhumika, and good morning to all of you. Before we begin, as a practice, we will now have Mr. Chandramouli read out our disclaimer, and then I will take the call.
Thank you, Anand. Good morning. During this call, we may make certain statements which reflect our outlook for the future or which could be construed as a forward-looking statement. These statements are based on management current expectations and are associated with uncertainties and risks are more fully detailed in our annual report, which may cause the actual result to differ. Hence, these statements must be reviewed in conjunction with the risk that company faces. Thank you.
Thank you, Mouli. Thank you all for joining us on this call again. I hope you and your families are keeping in good health. We meet again at the end of yet another challenging quarter. If I reflect back, it was a combination of pandemic-related lockdowns, increased incidence of infection amongst employees, and supply chain disruptions. Under these circumstances, in addition to managing current operations, the company had also focused on building all-round capabilities. All of us at the end of fourth quarter were thinking that the Q1 and then subsequent quarters would be better than the previous year. And April was an example of a great start most companies had, like we did. But the extent of the second wave, which we experienced in the second half of April and through May, is something that has taken the whole world, if not India, by surprise. And if anything, that has been an ominous reminder that this war with COVID is not that might end anytime soon. So over the past quarter, our primary focus has been to keep operations running safely across all our plants. We also ensured that all employees and their families are safe and have all necessary support as and when required. Even while we were running the operations in April and when the COVID really was raging on in the north and later on in the south, we did not think of an intensity of such nature, because last year was completely different. The COVID was far away from most of us, but this year it was very near our home. So it was sad that despite all our care, we still lost 7 people to the second wave, and also some of our long-standing dealer partners to this disease. At a company level, we had vaccination drives to cover about 75% of our employees and had also rolled out COVID care policy to provide support and improve their confidence. When this wave hit us in April and May, it also caused a lot of fear in our younger employees, and many of them went back to their hometowns. So that we had to bring them back, and only vaccinations could kind of remove that fear. So we had also provided infrastructure like oxygen concentrators to all our factory locations, and we also established quarantine facilities. In addition, we also had to face logistics challenges and increasing raw material costs coupled with poor availability. So this is the background in which we have a Q1. So in summary, the April to June quarter, the company recorded a sales of 465 crores at the standalone level, which was a near doubling of the top line of Q1 last year. And honestly, Q1 of last year is not a great comparison, that being COVID impacted quarter. But on a sequential basis, this marks a 8% decline, and this decline was caused both by the second wave disruptions as well as the above average base of Q4 of last year, which saw a lot of pent-up demand coming from abrasive segment. At a consolidated level, sales recorded 706 crores, and the sequential decline was lower at the console level at 6%, thanks to a positive performance in our overseas cities, which have also been seeing a second and third wave impacts, but at different points in time. So when it comes to the bottom line performance at the standalone level, on a sequential basis, we have seen a 8% decline in PBT for an 8% decline in top line. PAT, however, recorded a 10% growth despite lower share of profits from JV's associates. This is also mostly on account of the base effect. You may recall that we had extraordinary expenses in Q4 due to fair valuation of instruments. So while we did better than Q1, significantly better than Q1 of last year, at an consolidated level, operating profits declined by 17% sequentially. Lower quantum of profits at Sterling, CAPL, VAW, FZL have had an impact. However, margins continue to hold up in standalone abrasives despite the lower volumes caused by the lockdowns. May was especially terrible for abrasives, with very little dispatches happening to various parts of the country, which are all severely impacted by lockdowns. Overall, we have seen standalone abrasives margin softening by about 100 basis points from 17% to 16% sequentially. In the standalone ceramic segments, the volume impact and cost impact led to a 200 basis point softening of margins, and this cost impact was not so much from input prices but from mitigating the chronic labor shortages at the Hosur complexes, where we have our bonded abrasives, coated abrasives and super abrasives facilities, with the temporary labor returning home for the lockdown period and also the unbudgeted COVID expenses. Standalone EMD has been the silver lining of the last quarter, with margins increasing by almost 500 basis points. So we have done record volumes in some of our product lines and also managed to pass on some of the input price increases. In addition to a combination of product mix, which is favorable profitably, we also had a great run at Maniyar due to a good rainfall. Looking at the segment-wise performance in some more detail, the consolidated abrasive segment recorded a sales of 273 crores, making a 9% sequential decrease, and operating profits of 38 crores, marking a 25% sequential decline. Standalone operations had a very challenging April and May, with many auto OEMs shuttering their operations during the second wave. This was a combination of both the COVID incidences in their respective plants and also due to the semiconductor shortage linked disruptions the auto industry had. On an operational side, we did have some disruptions because of this in our Hosur plant due to the imposition of the lockdowns and also the acute shortage of labor. We utilized this opportunity to revamp some of our critical assets like the chemicals. But we were able to regain a significant portion of our lost sales in the month of June as we saw the lesser incidences across the country and the opening of the lockdowns. Our subsidiary in Ahmedabad, Sterling Abrasives, performed well on account of good demand from agricultural sector. After several quarters of lower volumes at our Russian abrasives operations due to the ailing home and European auto market, we are beginning to see some revival in demand. Coming to the ceramics segment, the consolidated sales recorded 173 crores, marking a 100 BPS decline in top line sequentially. As mentioned earlier, the disruptions in operations at the Hosur plant had impacted production and on-time deliveries. Consequently, our sales to our Australian subsidiary, Chemie Australia, and other exports were also impacted due to the non-availability of containers for exports. The orders from repairs and maintenance segments in domestic market have been particularly an encouraging story. What we are seeing is that after a year of on and off operations, many core industries are beginning to invest in these areas again. In minerals, the demand scenario continues to be good, both at standalone and global operations. This is also due to the fact that while the end user industries are seeing an uptick, there is also a hesitancy from many of our customers, or rather a preference from many of our customers to have an alternative source of raw materials from China, and that is also helping both our Russian and Indian operations. We also had an increase in input costs that were offset by price increases to some extent. As I mentioned earlier, the good rainfall in our in-house power generation facility at Mania has helped shore up our bottom line. This resulted in a 500 BPS improvement in margins sequentially. At the Concall level, it declined by 70 BPS. While in Russian operations, we saw good volumes in silicon carbide segment, and these volumes could have even been better. We lost some because of we have lost a few days of operations on account of incoming electricity supply disruptions and COVID-related no working days in the region. So we do expect the seasonal demand over Q2 to be better in abrasives and expect the good volume and realization streak to continue in minerals. In ceramics, we have a good order bank at Chemie Australia and expect the new mining projects in Australia to bode well for us in the near and medium term. We have also been seeing a rise in costs in raw materials and fuel, and we expect this to continue for a while, and this may have an impact on the margins. In terms of capex implementation, we have made considerable progress and spent 29 crores in Q1 on a consolidated basis. As I mentioned earlier, the focus is on our employees and keeping them safe, and we're encouraging employees to get themselves vaccinated by way of organizing medical camps in our factories. And as I said, 75% of our workforce is now vaccinated with the first dose and about 12% with both the doses. The work from home practice is now limited to about 10% of the workforce, mostly in offices. Now I request Mr. Padmanabhan, our CFO, to walk us through the financials.
Thank you, Anand. Good morning, everyone. Let me summarize the financial performance for the quarter ended June 30, 2021. The consolidated sales of 706 crore for the quarter has increased by 262 crores, which denotes 59% up over the corresponding quarter of last year. Of this, standalone sales of 465 crores showed an increase by 231 crores on a quarter-on-quarter basis. This is despite the lockdown-related disruptions by second wave of COVID pandemic. And as a reference, in the financial year 1920, Q1, the sales at consolidated level was 664 crores and 424 crores at the standalone basis. The consolidated segmental PBIT was at 114 crores, which is up by 88 crores and about 238% growth on the quarter-on-quarter basis. At the standalone level, the segmental PBIT for the quarter was at 78 crores against 7 crores during Q1 of previous year. On a consolidated basis, profit after tax and non-controlling interest for the quarter was 77 crores as compared to 22 crores in last year. As a reference, it was 52.8 crores for Q1 1920. At the standalone level, the PAT increased to 63 crores from 11 crores. At the PAT margin level, at the consolidated, it grew from 4.4% during Q1 of previous year to 11% in the current year. At standalone level, the PAT margin increased from 4.5 to 14%. On the segments, on abrasive consolidated sales for the quarter increased to 273 crores from 131 crores in the corresponding period of last year. Standalone abrasive sales increased to 224 crores from 101 crores. And at the consolidated level, the PBIT was 38 crores, increasing from the negative to 3 crores. Our domestic subsidiary, Sterling Abrasives, and Russian subsidiary, Olsky Abrasives, performed significantly well and showed positive growth on quarter-on-quarter basis, both in top line as well as in bottom line. On the electro minerals front, consolidated sales for the quarter increased to 288 crores from 210 crores in the corresponding quarter of last year. At the standalone level, sales doubled to 134 crores from 65 crores in last year. The consolidated electro minerals business showed a PBIT of 40 crores against 23 crores in the same quarter of previous year. The standalone level EMD segment registered good growth, while Russian subsidiary recorded marginal drop in revenue on account of the ruble depreciation compared to Q1 of last year. Consolidated sales of the segment grew by 61% on quarter-on-quarter basis from 108 to 173 crores. The standalone sales grew by 79% on quarter-on-quarter basis to 141 crores. Standalone ceramics business performed well despite delays in export logistics caused by the pandemic. Consolidated PBIT of ceramic segments for the quarter was at 33 crores, up by 21 crores from the same quarter last year. The entire increase was from the standalone ceramic business. On the finance side, the balance sheet continues to be strong, and the standalone continues to be a debt-free during the current quarter also. On a consolidated basis, the debt-equity ratio was 0.02, and the total debt on the consolidated basis was 45 crores. And the forex cover, CUMI is typically a net importer in dollar terms and net exporter in euro terms. We cover the net exposure in accordance with the policy. And the strong balance sheet, good cash position, low debt equity ratio, and setting off with the net surplus, we are at 6 crores of net surplus, liquid surplus. This concludes my update on finance. Thank you.
Thank you, Paddu. And over to you, Bhumika.
Yes, sir. Moderator, can you please open up the floor for Q&A, please?
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on the touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. Participants, to ask a question, you may press star and 1 now. The first question is from the line of Ravi Swaminathan from Spark Capital. Please go ahead.
Hi, sir. Congrats on a good set of numbers. My first question is with respect to what would have been the kind of revenue loss this quarter because of the lockdowns would have been there. You can throw some.
You may, if we didn't have the lockdowns in May, right?
Yeah.
I believe that bulk of the sales was lost in abrasives and also some in the ceramic segment. And if we had not had that lockdowns, we could have done about another between 30 to 40 crores more.
At overall company level, this is?
At an overall company level.
Got it, sir. And would we have gained any market share in the abrasive segment from the competitors or from, say, the unorganized players, especially the Chinese imports? Just wanted to get your sense whether are we or the organized sector, are they gaining share from the unorganized people?
Yeah, I remember that you asked this question last time as well, but or one of the participants asked, and I think we have definitely gained. That's my sense of there's the feedback I get from the market and also my colleagues who are handling the abrasives segment. Definitely from the thin wheel segments and also on coated, definitely we have gained, I would say. We also have gained significantly, I won't say significantly, but definitely have gained strongly in the precision abrasives segment. The reason being that many of the customers on the precision abrasives, which is the auto component segments, while do we have competition both from domestic and from imports, having someone local to support them very quickly has helped them. So we are seeing a preference towards that. So the precision abrasive segment is definitely have gained in market share.
Got it, sir. And my final question is with respect to overall revenue growth for this year. Are we in line to achieve a double-digit revenue growth at a consolidated level over last year? And with respect to margins, given the fact that good costs have gone up, fuel costs have gone up, are we in a scenario to maintain the record high margins which we had seen last year, which was around 17.7% EBITDA margins?
See, as for the revenues, I believe that we would be, as a consolidated basis, we can hit a double-digit growth. Again, given that the base was low last year. And on the margin side, and I must put in a rider here because everywhere we are talking about the third wave coming. So I hope that we don't have it, but unfortunately we are already seeing the beginnings of it in other parts of the world. So I hope that we don't have it. But if things are normal and going the way, I don't see any reason why we shouldn't hit a double-digit growth on top line. On the bottom line, yes, many of the commodities prices have been shooting up and significantly. And while we are working on two fronts, one obviously on seeing how do we depress our variable costs, we're also trying to push out some of those costs to the customers as well. And that's not in any time is easy, and so that's where we have the challenges also. We'll endeavor to keep the margins or be close to where the margins are currently.
Got it, sir. Thanks a lot.
Thank you. The next question is from the line of Vineet Mani from Birla Sun Life Insurance. Please go ahead.
Hi, good morning, sir. This is Vineet from Birla Sun Life AMC. So my question is again regarding your margins. So we've seen your gross margins have actually been improving, right? So could you just give us qualitative commentary on segment-wise, how pricing as well as raw material has behaved? So is it mainly because of EMD only, or, what's happening in other segments? Could you just talk about that, please?
Yeah. We have seen a margin improvements in all the three segments. If I were to start with abrasives have been systematically improving their margins over the last few quarters. It has been a combination of very diligent work on the cost front, improving efficiencies, improving yields, reducing energy costs, energy consumption. Very scientific work. So that has definitely helped both in the coated abrasives and in the bonded abrasives segments. We have also chosen raw materials which will give us lower losses. So that has been a work which has been done on the operational side. And on the marketing side, it has been a very systematic way in which we have worked on those product groups which are better profitable, but also have opportunities to grow, and consciously reducing or moving away from those loss-making product groups. So it's been a combination of both, and that has definitely helped us in abrasives. In the case of ceramics, as you know, that the bulk of our ceramics in the standalone and also in the case of Russia goes into the exports market, and these are technical ceramics. And despite the lockdowns even last year, the end-use markets, which is the fuel cell market or the alternative energy markets, the power transmission and distribution markets, they have been doing very well. And these are custom-built products and of a better margin profile. And that is where we have been focusing on building the volumes. So that has definitely helped in the ceramics. In the minerals business, while silicon carbide produced in Russia has always had a better competitive advantage due to its position in Russia with access to competitive raw materials and energy, the work which the minerals team in India has done in terms of generating more volumes from the existing assets. So they have been able to sweat those assets to create more volumes and also significantly change their product profile to ones which consume less energy, which has helped them both by specific energy consumption, thus lowering the cost of energy itself, and also churning out volumes which help in a better fixed cost coverage. So all these actions have helped these businesses and resulting in possibly a better margins overall.
Right, sir. Sir, you spoke about, some expenses that you had to incur because of, COVID-related, let's say the lockdowns or bringing back, workers to the plant, etc. Would you be able to give a, rough estimate of what were these additional expenses which might not recur going ahead?
See, in this quarter, as I said, there was a combination of healthcare expenses related to COVID. As I said, we also had some fatalities. We also took care of people. I mean, it did not depend on what level they were, whether they were permanent employees or workers, transient workers. Some of them had to be hospitalized for extensive period of time, and the company picked up the bills of all of them. We also provided infrastructure in terms of oxygen concentrators, setting up one oxygen concentrator for hospitals here in Chennai. So altogether, we did about, I would say, we would be about between 1.5 to 2 crores is the spend that we have towards this.
Okay.
As additional expenses. This includes the contributions that we have made over and above the CSR committed spend to the government in Chennai, in Tamil Nadu to support the COVID fight.
Understood. And this obviously this is mainly in standalone numbers where it would be reflected.
Standalone numbers, yeah. So we had similar numbers in our Russian subsidiary as well, because there you would realize that the number of people in the plants are about 1,800 workforce, and about 200 and odd people are still in quarantine. So they also had to spend a substantial amount of money in terms of their health support. So.
Sure, understood. So my last question is, in the P&L account, there seems to be a large inventory change number, which shows that we've had increase in inventory.
Yeah.
Which is pretty large, relatively, if I look back at the history.
Absolutely, yeah.
So if you can just throw some light on where have we built this inventory, etc.
Yeah. So we were always tight on inventories, but this quarter has been exceptional. So we had locked up inventories in the 2 counts largely, one on the raw material side and on the finished goods side. On the raw material side, as you well know, that the abrasives division and also the ceramics segment import bulk of the raw materials from overseas. And in the abrasives segment, we do significant imports of the grains from China, and beginning of Q4 and in February, when the Chinese New Year starts, and we all know that the Chinese go on a 15-day holiday, so we normally tend to schedule more in the just before the holiday starts, in the event that something happens to the supply chain. But unfortunately, we did not receive those materials on time, and then when the materials were on the way, you had disruptions in terms of April and May. So the materials started coming in, and some were stuck in the port, some were yet to receive in the plants. So we were at a loss in terms of how to dilute that. We were not producing as much as we should be doing. So this ended up in a piling up of raw material inventory, all good inventory, and this inventory will be diluted over the next couple of quarters. The same story is there for the ceramics division as well. Many of the raw materials getting stuck, and we also had to, some of the critical inventory had to fly them in, so which added to the cost. On the finished goods side, as I said, the container shortages, the people not being available for production and dispatch also caused the WIP and the finished goods to remain at the plant and not go out of the door. So that also impacted the finished goods inventories significantly. But these are, I would believe, exceptional events, and in Q2 and Q3, definitely most of it will be sorted out in Q2.
Sure. Yeah, understood. Thank you very much.
Thank you. The next question is from the line of Bhavin Vitlani from SBI Mutual Fund. Please go ahead.
Thank you for the opportunity, and congratulations for good set of numbers.
Thank you.
Sir, if you could speak about the end market outlook for the abrasives, and if you could also give us a color on the pricing environment as well as the input cost that we are seeing?
Yeah. See, the abrasives segment broadly, as we all know, is into precision and in mass market. And in mass market, we have both the bonded abrasives and coated abrasives, which deal with whether it is housing, infrastructure, or the engineering segments. So when we saw in Q4 and Q3 and Q4, the engineering industry is coming back, especially auto component industry is coming back strongly, which also indicated that the second tier and the third tier companies and the engineering companies also doing well. So we see that the precision abrasives, the demand for precision abrasives has been growing, but still not to the pre-pandemic levels, I must say. We saw that grow in Q4, and while it did grow significantly in April, we saw the slowdown in May and a little bit in June. And July, we are seeing an uptick again. Now, we believe that this end-use market will remain robust if we don't have the third wave. And that is what all of us are praying for. And hopefully the discipline of vaccinations will help. In the mass market segments, coated abrasives has seen an uptick with possibly more and more home renovations, building renovations happening, and many companies or many I would say many commercial buildings also, which has been closed down after the pandemic, reopening now, getting renovated, is also helping in moving these coated abrasives products. So overall, the mass market and the precision abrasives market, which is the link to the auto component, has a positive demand. In terms of the cost push, yes, we are seeing cost push on the raw materials, significant increases in raw materials, and we have also been implementing price increases across our product lines. Some of the cost push can be passed. Yeah.
Sure, thanks. My second question is on the ceramic segment. In the previous interactions, you did highlight about expansions that we are looking to we are looking at, considering the growth that we are seeing on the renewable side of the business. If you could give us an outlook, where are we in the process? What is the kind of investment that we're looking at? And from the current level of the technical ceramics, how should one think about this business on the next 3 to 4 year basis?
See, the technical ceramics is what we are currently in and building upon is on the alternative energy or green energy sector, I would say. Technically may not be very green because it's based on solid oxide fuel cells which use natural gas. In that sense, it is still a fossil fuel, but a much cleaner burning fuel. So that is one segment which we continue to work on and build with. So because there the opportunity is in terms of working with customers and building their next version of the products. So I see that that segment will continue, or that industry segment will continue to do very well, given the fact that it is most of these are located in the Western world, where the companies and the countries are promoting the sustainable development goals seriously. And the other segment is also the power distribution segment, transmission and distribution, and generation transmission distribution segment, which is seeing a lot of the metallized cylinders used. So whether it is a larger cylinders which we now manufacture for high voltage power stations, or the smaller cylinders which we are now seeing more from renewables energies for rooftop solar, etc. That is a segment which again will be driven by the SDG goals. So these are positive trends. Ceramics also has opportunities in electric vehicles, and here we have started work last year to qualify our products in some of the end users in the EV space, and that is seeing traction as well. So overall, good, I would say a good outlook for the ceramics business going forward, and most of them linked to industries which are the future drivers of economy.
So just a follow-up, can this segment grow at the rate of 20-25% over the next 3-4 years, given the strong tailwinds as you outlined currently?
See, we today we are about I think in the high teens or early 20s, and yeah, that is one. I would think that that is something which we can do consistently in this segment. Whether it will move from the high 20s to mid 20s, high or late 30s or late 20s remains to be seen. But I think all depends on how fast the evolution of EVs will happen, which can drive possibly the segment faster.
Sure. Yeah. Thank you so much for taking the questions.
Thank you. The next question is from the line of Charanjit Singh from DSP Mutual Fund. Please go ahead.
Hello, sir. Good morning.
Good morning.
Yeah. So first of all, congratulations on great set of numbers.
Thank you so much.
First question is overall on the exports as an opportunity. How do we see that? And from the size where we are in the exports, like ceramics has done well for us, and in the other segments also, how you see the scaling up of exports? That's my first question. Yeah.
Okay. See, the nature of the businesses are different segment to segment. In the case of ceramics, it's a business which has got global customers, right? So the customers are global. So but they sell the products also globally. So naturally our exports share of exports in our businesses is very high because we deal with B2B customers and work with them, co-create products with them. In the case of the ceramics, which is heat-resistant ceramics, it's also very similar. So you have customers who are global, whether it is glass customers, carbon black customers, cements. So these are our global customers, and we work with them on their projects. So the nature of the ceramics itself lends to higher exports than other businesses. In the case of abrasives, it is a global business but very localized in nature. So every country will have its own set of abrasives manufacturing, whether it is a bonded or a coated, because it is required for shaping and finishing metals. And that's the reason why we are also predominantly strong in the domestic market. Where we have been successful and growing outside the country in abrasives is those precision abrasives which are differentiated from the rest of the producers or rest of the competition in terms of offering a better better value proposition, I would say. And that's what we are seeing in the US and in Europe or in the Far East. So the nature of the business determines how we compete and where we compete. And while we know that the abrasives definitely in the export market is about what we do from India is about 10% of our sales. There is an opportunity for us to leverage this goodwill and grow further in those markets. And obviously, the way to do that would be through an inorganic growth, and that is definitely on the agenda. As we progress, we will continue to keep our eyes open on those opportunities. In the minerals business, again, it's a global business, but it's a bulk volume business. So the specialities are the ones which would be more export friendly. Hello?
Okay. Yeah. So thanks for that answer. So the next question is, especially on the mid cylinder. So net cylinder, in terms of our capacity utilization currently, what's the level, and how do we see the ramping up of the capacity going forward?
We did implement what we call a 2.5 METS line in the last year during the pandemic, and that has been completely stabilized, and we are also gained customer approvals because these things require to be approved by customers, and that is happening. And today the new line is about, if I would remember right, is about 40% utilized already. So this is an area where we would continue to invest because it has to be invested in tandem with gaining new or acquiring new customers and gaining their approvals. Yeah.
Okay.
So I would say overall it would be about.
Yeah.
Sorry.
Yeah, sorry, sir. Go ahead, please. Yeah.
No, I would think that on the metallized cylinders line we would currently have, including the new line, is about 75% capacity utilization.
Okay, sir. And so lastly, sir, while you have talked about, the auto as an end market, if you can touch upon, the other end markets like be it metal, cement, how those, end markets are behaving across product categories?
Yeah, broadly cement is one. I mean, steel and cement are the ones which are doing pretty well. And in terms of steel, we supply products right across our segments, whether it is abrasives for example, roll grinding of steels, or in the case of refractories for both for projects and repairs and maintenance. Not so much for daily consumables, refractory consumables. We also supply quite a bit of lined equipment for the steel industries. So these are definitely picking up. So we see the project orders coming in increasingly compared to last year. The consumables like roll grinding continue to be a good market to be in. The electrominerals business supplies significant amount of raw materials to both the foundries and to the steel industry. And that is one reason why we also saw the pickup of electrominerals this quarter, and we believe that is going to be a continuing business, and we can see better growth there. In addition to the inherent capacity of these industries to consume a lot of raw materials, we are also seeing that there is, as I said earlier, a reluctance or a prudence, I would call it. I wouldn't call it a reluctance. I would call it a prudence by end users to source materials locally, given the potential disruptions in the future to whatever reasons. And that is also one giving us some impetus in terms of unearthing more capacities from our current assets on the electromineral side. Carbon black, which goes into manufacturing tires, is definitely will be on a roll, both from an OE perspective and also for the replacement tire market. So that's continuous a good growth industry to be in. Non-ferrous industries like aluminum, copper, zinc, all of them continue to have picked up, and many of them are in the infrastructure space as well. And that will give us opportunities in composites, where we produce the electrolytic cells using polymer composites for refining of copper or zinc, and that's augurs well. In the aluminum industries, the ceramics, which supplies heat-resistant ceramics both from Russia and from India, are definitely looking forward to the aluminum industries doing very well, and that will continue. So overall, I would say the base metals like iron, steel, copper, zinc, all of them hold promise.
Okay, sir. Thanks for taking my question, sir. That's all from my side.
Thank you. The next question is from the line of Aditya Mongia from Kotak Securities. Please go ahead.
Hi, good morning, everyone, and thanks for the opportunity. The question which I had was on your opening remark in the EMT segment, wherein you talked about the benefit of China Plus One.
Hello? Hello, Aditya?
Mr. Mongia,
Hello?
sir, your voice is not audible. Mr. Mongia? The line for the current participant not audible, so we'll move on to the next question. The next question is from the line of Jason Sons from Ashika Stock Broking. Please go ahead.
Thank you for taking my question, sir. I just wanted, my question is more on a broader level. So in terms of India also, we see a lot of initiatives taken by the government, such as NIP, the PLI schemes, and even globally also there is a lot of emphasis on infrastructure creation, be it the US passing the bill, an important infrastructure bill. So in light of the same, for the next 2 to 3 years, from a broader outlook, how do you see, abrasives, ceramics, or electrominerals? What do you see the growth path and the growth outlook for all these segments?
Yeah. See, among the PLI schemes, for example, for these between 10 and 13 sectors, which has been announced by the government, many of them are related to, for example, the auto component industry. Some of them are into the advanced cell chemistry manufacturing, into solar and solar mobility, and EVs obviously will be part of that. And we also see specialty alloys, and also aerospace and defense. So see, these are some of the sectors which are covered in the PLI schemes. And obviously, with our presence already as a reputed consumable supplier to the auto comp industry, we see this as a good opportunity for abrasives. In the case of whether it's infrastructure building, we would definitely require abrasives, both in the coated abrasives and in the I would call the mass market or the power tool driven abrasives, because that's definitely going to be linked to productivity, and hence that's the bright spot for abrasives overall. Same is the story when we're talking about specialty steels, because specialty steels, and even in the steels where India is poised to grow its capacity significantly. So the temperature or the heat containment refractories or ceramics for these specialty steels, the abrasives go into them are all an opportunity that we see in this PLI schemes. One area which are the new areas of where materials can come in is obviously the advanced cell chemistry, and there this goes for energy storage for both for renewables and electric vehicles. And here additives like high purity graphite and graphene will be required for improving the energy density and energy storage of these battery elements. So it definitely provides CUMI as a whole a good opportunity.
Sure, thanks for that, sir. And I just also wanted you to touch upon, we can see that there is...
Jason, this is the conference operator, but there's a disturbance coming from your line, sir.
Okay, is it better now?
Sir,
yes, much better.
To mute your line after you...
yeah, sure. Sure. Okay. So, sir, just wanted you to touch upon, there is, you've spoken about your product mix improvements. Basically, you said growth will emanate also from mass market products as well as specialty products. So just wanted you to touch upon and give some color on your product mix improvements, as you just spoke about abrasives and you want to increase that export contribution from 10% and above. Even for electrominerals, you will want to, increase the contribution from specialty minerals, which, for basically high purity silicon carbide, etc. So the specialty minerals and ceramics as well. So just wanted you to touch upon, some comment on the improvement of product mix in each of the segments.
See, the internal targets what we have for these specialty products, whether it is in largely, let's say, in minerals, has been in the region of about 20-25%. So ideally speaking, we would like to have over 30% of our mix in these and what we call the adjacencies or the performance materials, and 70% as the workhorse materials, which will give you that kind of a solid foundation. But when we are looking at minerals specifically and increasingly growing on the core materials, in terms of percentage share, the specialties may come down, but I would broadly say about 20% of our product portfolio should come from specialties now.
Okay, thanks. That's all from my side. Thank you for answering my question.
Thank you. The next question is from the line of Sajid Jain from ASK Investment Managers. Please go ahead.
Sir, our compliments on very good set of numbers. If I look at GNO's number, Granville Norton's number, their average numbers, the top line has gone down by about 20% QOQ. Ours has gone down by about 9%. So have we gained market share from the number 2 player in the market in abrasives?
As I said, the GNO's number going down by about 20% and ours going down by about 10% has to be seen from a higher base in Q4. But having said that, I believe that we definitely would have gained market share, and both in the precision and in the mass market segments. Obviously, there are some segments where GNO is strong, and we have, we tend to gain some from them, some from others, but overall, yes, we should have gained market share.
And these market shares would be sustainable?
That's what you're working at.
Sure. And the SOFC, the solid oxide fuel cells and the hydrogen applications, which I believe are overseas sales, how large this has already become? From channel checks, it suggests that it is already at 80-100 crores per annum. Is it true?
I won't comment on that. But suffice to say that yes, it's a growing market. Yes.
Meaningful currently in terms of contribution to the overall top line?
No, it is. I would say it's a reasonably good share of the sales and contributions. Yes.
Right. And EVs, you have spoken in the annual report about bulk supplies of ceramics to EVs. If you could throw some light, has it come to some critical mass already?
You're talking about the graphite or
you've spoken about bulk supplies of ceramics in the EVs.
Yeah.
Electric vehicles.
So, what we're doing on the electric vehicle space is on two sides now. One from the ceramic side, where we are already supplying parts to the EV manufacturers, which goes into the power management systems or insulation systems in electric vehicles. So it is agnostic of any manufacturer, any technology. So it's components which you will find in every vehicle. So it is not that you are tying yourselves with technologies of a Suzuki or a Toyota or a Tesla. So I believe that this segment would significantly grow along with the adoption of EV vehicles. We also have started our testing and commercial supplies of the graphite and the graphene for enhancing the properties of batteries. And here, when I say commercial, it is I would say it is still not commercial from a sense of putting it into a commercial battery for vehicles, but more from a sense of long-term testing of these batteries. So these are maybe significant in volumes for us, but it is more for a testing and evaluation for the end users. Bulk testing, I would call it, or stage 2 testing.
Right. And we've clocked 18.8% EBIT margin in Q1. That is kind of lower than if I look at 4-5 quarters previously. Is it a one-off? And eventually, do we get back to 20% plus kind of margin in ceramics?
See, the margin decline there is also significantly impacted by our Australian operations. As I said, many of the containers which could not reach them, and though they have orders in hand, they could not convert that into sales, and hence it has been impacted. So I would put it down to probably a one-off thing, and we should get into a regular ream of margins in the next couple of quarters.
Right. And one last final question is on ceramics, which clocked 627 crores in FY21. Previously to the question which was asked to you, you said is that 20% kind of 20% north of 20% kind of growth is possible. Then that means that in practically 3.5 years we can double this segment.
Yes, that's our goal and our intention as well. Yes.
Sure, thank you. And if I may just ask one more, construction chemical products, you mentioned that for waterproofing. Yeah. What is the potential there? There are already significant dominant players in this field.
Absolutely.
The adhesives and the construction chemicals. What is the potential for CUMI?
See, we are seeing as two parts. One is in terms of leveraging material sciences understanding, because we do produce our resins and formulations in this space for anti-corrosive, acid-resistant proof chemicals. So this is a niche. Industrial niche is what we're looking at in construction chemicals, because we already supply other products as well to the same end-use industry. So whether it is in sulfuric acid manufacturing or in petrochemical industries or in refineries, we supply other materials. So this would go out as a package along with these materials. It may not, if it kind of gets some traction, then we can also look at using our existing channels in abrasives for retailing some of these construction chemicals for residential, home, commercial applications as well. So the focus now is more on the industries and the industrial solutions, and then later on to retail.
Sure, thank you and all the best.
Thank you so much.
Thank you. The next question is from the line of Manish Goyal from Enam Holdings. Please go ahead.
Yeah, thank you so much, sir. So continuing on products mentioned in the annual report, there are a couple of more which were emphasized. One was on the sintered silicon carbide ceramics, which were the facility was commissioned. So if you can throw some light on that product and what is the potential market, number one, and number two, also you have mentioned within ceramics in terms of we already started with setting up pilot projects for 3D printing and probably do some niche products at the moment. And so how do you see this opportunity also evolving? Thank you so much.
See, there are, in the case of sintered silicon carbide, this is a very specialized product process, and the silicon carbide products which are used in high corrosion and high wear resistance applications, whether it is in the nuclear industry or whether it is in aggressive chemical industries. So these are the products, whether it is the seal faces, whether it's ceramic parts for pumps, etc. It will also find some use later on as in the ceramic bearings for bearing elements, rolling elements in bearings. So these are the potential areas that we can work on. And currently the facility has been commissioned, tested, and we do have some approvals from end users. So we are hoping that this year we'll see a faster acceptance of those products, and we are looking at growing there. In terms of the potential, I won't be able to, it's a number which I can give, but does not mean anything unless we have those facilities and proven. So we are looking at the first year at least as a pilot. In the case of can you repeat the second question? 3D printing. 3D printing, 3D printing is one forming capability that we are adding to our repertoire. You would realize that engineering ceramics, which requires very small parts, very intricate parts, are sometimes not possible to make using conventional forming processes, or is very expensive. So we have equipped ourselves with initially polymer 3D printing facility, which we can do prototyping, and then now in the next quarter we'll be equipping ourselves with the ceramic 3D printing, and that will kind of enlarge the capabilities that we can possibly offer. And this will come in handy when we move more, I would say, more purposefully in the aerospace and defense applications.
Okay. Fine, sir. Thank you so much.
Thank you. The next question is from the line of Harshit Patel from Equirus Securities. Please go ahead.
Hi, sir. Thank you very much for the opportunity. Sir, you had earlier highlighted that the FY22 capex would be around 150 crore. You had also highlighted a few plans for each of the segments. So, sir, is everything on track, or has there been any change in the way we are going to do?
We have done about 29 crores in Q1 on a Concall basis, and I think we would be largely in track to complete. I would estimate, we will do about 130 crores and plus minus given the pandemic in that region. Yes. So, but the projects what we have picked up in all the businesses are on track.
Sure. So, sir,
you may see some allocation, from our original plans towards other businesses. For example, EMV may get a little bit more because of the conversion capacities that we are building up there. But while we are still within our 3-year plan window, the allocations may kind of a shift a little bit, but mostly it will be in ceramics and EMD. Of course, abrasives also has a chunk of spend coming up.
Right. Sure, sir. So, you are also looking at some sort of inorganic expansion in both abrasives as well as ceramics to improve our technical capabilities as well as the market reach. So, sir, has there been any update on the same?
We do continue to explore opportunities, and both inside and outside the country. So we have been doing some initial work, shortlisting and doing some progress. But the pandemic has not helped. The travel restrictions, especially to US, has not helped in bringing them to a close. Hopefully, over the next couple of quarters, we'll have more progress to report.
Sure, sir. If I could squeeze in one last question, then sir, a couple of quarters back, you had mentioned that we had acquired a couple of institutional customers in the abrasives space in the North American market. So, how is the ramp up over there? And a related question would be that in abrasives, the subsidiary margins were pretty much low vis-a-vis last 3-4 quarters performance in this quarter. So, what would be the reason for that?
See, the subsidiary performance in the US?
Sir, in the overall abrasives.
In overall abrasives. See, overall abrasives has definitely been impacted by the lower sales in especially in the US. Because of these lockdowns, the sales have definitely dipped, and consequently the fixed costs are fixed, and consequently the margins are lower. And here the effort is also to not only build a strong base like the institutional buyers, what I was talking about, but also to have a base for our coated abrasives products, which for segments like hardwood flooring, which are I would say it's not so standard a product, but then it gives you a solid foundation for one to grow from, and that's a plan for the abrasive segment in the US. The abrasives is largely from China, where of course I would say that we have not been able to travel into China for the last 18 months, so it has been kind of coasting along, I would say. But in the case of abrasives in Russia, we saw very weak offtake from the Russian market, but it's very nice to report that this last quarter has been a better abrasives show from Russia. So hopefully this demand there will grow as well, and we'll see better numbers.
Sure, sir. Thank you very much, sir, for taking my question. Thank you.
Thank you.
Thank you.
The next question is from the line of Bhavin Vitlani from SBI Mutual Fund. Please go ahead.
Thanks for the opportunity again. We've seen considerable increase in the polysilicon prices, and what I was keen to understand is whether our SIC and we were working on high purity.
Mr. Vitlani, your voice is breaking, sir.
Yeah, not very audible.
Am I audible now?
Sir, I would
it's breaking up, sir.
Better reception area, sir. It's still the same.
Okay, is it better?
Please go ahead. We'll see if you're able to catch the question completely.
Sure. The question is on the high purity SIC, and as we are seeing the increase in the polysilicon prices, do we see that as an opportunity to substitute and a growth that could come in the SIC for us?
Yeah, it's a good question, and see, the high purity silicon carbide is not for abrasives or for refractories. It's for the electronics applications, and here we are talking about high purity silicon carbide as a substitute for silicon wafer in electronic parts as IC chips, and these are going to be more. You will find them more and more in 5G components or in high power density applications like in EV power systems, transmission systems, laptop adapters, etc. So wherever you need a high power, high current applications is where the high purity silicon carbide will come into play. This is I wouldn't call it a substitute for what we are doing, but I would say this is the next natural progression of what we are already producing or can produce. And this is one area which we are working on. Making silicon carbide from 99% purity to 99.9999% is the work which our R&D teams both in India and in Russia are working on. And we are very, very hopeful of meeting those kind of a purity levels soon. Yeah, it is an exciting part of the materials going into the future.
Thanks. Second question is, in our past interaction, we have highlighted about opportunities in the solid state batteries, which potentially could be taking over the conventional batteries. Any update on that will be useful.
See, we are not into any battery manufacturing, but as I said, only in the elements of the material elements that go into those batteries. Some of the elements are, for example, to prevent the thermal runaways, which is using ceramic fibers or even what I would call a tape cast ceramics. So those are some of the things which are working with those battery manufacturers, but not directly manufacturing or getting into the manufacture of batteries themselves.
Sure. Thank you so much for taking my questions.
Thank you. The next question is from the line of Sanjay from Ampersand. Please go ahead.
I said thanks a lot for the opportunity. I just asked two questions. One, though you have already explained in many which way, but I just wanted short answer. That are all the problems relating to logistics and everything else more or less behind you, or still there are some issues? Let us not really build a scenario of the third wave, but as it is, how the situation is.
I think it's an excellent question because I don't think any of us are behind these logistics issues. That's my personal view because the container, there are two parts of the logistics issues. One is the container availability, and this non-availability or limited availability pushing up the logistics costs. The second is also the availability of bulk cargo carriers, and we use some of them for shipping out or shipping in the Reliance, the petroleum coke from the Reliance Jamnagar facility or calcium aluminas. And as I see that the container shipping problem will carry on for at least another year, because I understand from some of our the vendors and logistic partners that the container availability globally has been impacted because of the pandemic, starting beginning of last year. So many containers which are shipped out to countries like South America are still there, or to US, and some of those ports are chock-a-block with containers, and they have not come back to their point of origin. So which means that if they are not going to come back, and they're going to stuck somewhere inland in South America, so they have to be compensated by new containers. So manufacturing of new containers are not going to be quick, and they will take time, and hence there will be a shortage of containers themselves, which will continue to impact logistics costs and also material availability. That's my take.
Sir, considering how dynamic this situation is, and I'm sure as a smart and agile company like you really would be thriving in such a scenario, because you would be doing a better job than your competition. But this is something which is to deal with the present problem. But are these issues like this affecting your long-term plan of investing and driving an accelerated growth? Because as I see that before pandemic, for 3-4 years, you have been growing at about 10-12%, and much before that, you used to grow at a much higher pace. So does this kind of impact your ability to go back to 15-20% kind of growth, and with new product launches? All these issues, and because you are not really investing in some of the longer term capability?
See, it's a fair question. If you look at most of us have taken logistics for granted. I would say we know that. We all thought ships are available, containers are available, and things will be all hunky dory. But there are emerging newer ways of even shipping out material. To give you an example, we have rail lines which are now opened from Russia, from Moscow to India, part rail, part ship, and we are exploring that as well. So which means that you can cut down on your shipping costs, and possibly the time will be significantly lower. But we also see this as an opportunity to grow in various geographies, and that is the reason why I believe that local manufacturing wherever we are, and increasing the local manufacturing, will be in one way mitigating these risks. And while, for example, our customers also say facing the same problem. So our customers in India may want to not import a lot more because of the shipping issues, but have someone reliable who is quality conscious, they can work with on a long term locally, and that presents us opportunities to grow. So that's what we are looking at and working on.
Thanks a lot, sir.
Thank you. As there are no further questions, I would now like to hand the conference over to Ms. Bhumika Nair from DAM Capital Advisors Limited for closing comments.
Yes, thank you very much, everyone, for being on the call, and especially the management to give us an opportunity to host you, sir. Wishing you all the very best.
Thank you so much, and thank you all again for logging in to this call. So what we see is, as we progress into Q2 and further into Q3, we continue to see disruptions globally. As I said earlier, a possible third wave in India. We also saw recently geopolitical disruptions on South Africa. We are hearing about nature's fury in China, especially in areas where minerals are made and abrasives are made. We're also seeing rapid COVID cases rising in China, US, and Australia. So while we are all cautiously optimistic, we have to get through these potential hazards with as little damage as possible, and also stay focused on building capabilities to face the future. So that's what we intend to do, and thank you all, and stay safe.
Thank you. On behalf of DAM Capital Advisors Limited, that concludes this conference. Thank you for joining us, and you may now disconnect your lines.